We've just found out what Michael Burry and Warren Buffett have done to their portfolios over the last quarter of 2023. So I thought this would be a great time to drill into some of those changes, which are truly fascinating. This isn't so we can copy what they do, which I think would be foolish. It's to try and understand some of their thought processes and also to better understand what's going on in markets right now. This video is sponsored by Stockopedia, which provides easy-to-use research tools that save you time, help you act more decisively, and improve your success rate. Now, the data I'm going to be showing you comes from 13F filings. These are regulatory filings in the US. They do get published with a lag, so we can only see what was in the portfolio as of the end of 2023. Also, they have certain limitations. They only show long positions. You won't see any cash positions. You won't see any bond positions. All you see is US publicly traded stocks and also ETFs, some ADRs, these are foreign stocks listed in the US, and some derivatives like calls and puts. So if there's a big cash holding, for example, you're simply not going to see it. And that's why if we look at Michael Burry's holdings, according to the 13F filing over time, you can see that the amount he seems to have invested increases dramatically. So in 2022, it always seems to be that he has less than $10 million invested, whereas in 2023, that surges to over $100 million. Well, that's probably because he held it in cash or some other form of holding which we don't know about. Could be international stocks, for example. But what I think is really clear is that he's not bearish. This is somebody who's fully deployed their capital and is long the stock market. So far from being a perma-bear, someone who's permanently bearish on stocks, it looks like Michael Burry is pretty bullish at the moment. Now, the colours that you can see here in the vertical bars are the individual stocks that he holds. And what's pretty clear is there are lots of colours, and that's because he holds a pretty diversified portfolio. So if we drill into his portfolio at the end of 2023, you can see that none of his holdings exceed 6% of his total portfolio. So clearly he is risk managing this portfolio very carefully. He doesn't have a position which is too large in any one stock. The colours here represent sectors. However, you can see that there's quite a lot of light blue, and that's consumer cyclicals. Now, cyclical stocks are very linked to the economy. If there's a recession, they tend to underperform. If there's a recovery, they tend to outperform. So the fact that Michael Burry not only has lots of equity exposure, but also lots of cyclical exposure tells me that he's pretty bullish about the US economy. And as we'll see in a moment, not just the US economy, but also that of China. If we look at the sector composition as a pie chart, what you can also see is that it's not just cyclicals he holds. He also holds some defensive sectors, for example, healthcare, and also a tiny sliver of consumer defensive stocks. So if I had to characterize that, I'd describe it as a kind of barbell strategy. He's bullish on the economy, but he's also got some defensive stocks in case that bullish opinion doesn't pan out. So that was a snapshot as of the end of 2023. But what about the quarterly changes? If you look at that, what's pretty clear is just how active Michael Burry is. The top part of this graph shows you all of his new holdings, and they're very significant. So for example, he's got new positions in HCA Healthcare, a defensive stock, but also Oracle, a tech stock, and a financial company, which is Citigroup. He's also entirely cut his position in 4 stocks, those you can see at the bottom of the graph, while in other cases he's simply trimming his bets, which presumably have panned out, and he just wants to take a little bit less risk now that he sees less upside for those stocks. For example, after the pandemic, he bought 2 industrial stocks which are to do with shipping. That was Star Bulk Carriers and Safe Bulkers. But the biggest change he made, and the one which everyone's talking about, are his big bets on China. So he increased his position in JD.com and Alibaba. So what would be the attraction of buying Chinese stocks right now? Because everybody else seems to be running in the opposite direction. This is quite a contrarian bet on behalf of Michael Burry. Well, if we look at JD.com, for example, this is China's answer to Amazon. And if we compare it side by side with Amazon here in Stockopedia, the differences I think are quite illuminating and also give us an insight into why he made this choice. Of course, the market cap of JD.com is much smaller than it is for Amazon. But if we look at the stock ranks at the bottom of this page, I think we get an insight into what's going on. Now, the overall stock rank of the two stocks is very similar. JD.com is 82 and Amazon is 85. However, if we dig into those stock rank numbers, into their components, the one which really stands out is value. The value rank of JD.com is a huge 96, whereas Amazon is just 16. In other words, based on various valuation measures, JD.com is incredibly cheap and Amazon is very expensive. Now, you might be thinking that's because JD.com isn't a very good business. Perhaps it has lots of leverage or it doesn't have good profitability. Well, that's not the case. If you look at the quality rank of the two stocks, they're both pretty positive. JD.com is 91 and Amazon is 98. So it's not that JD.com is a bad company. That's not why it has a very low valuation. But if you look at momentum, clearly this is a beaten up stock. JD.com is just not very popular at the moment, whereas Amazon is very popular indeed as part of the Magnificent Seven in the US. So really the elephant in the room here is that JD.com is domiciled in China, and that's why nobody loves it. It's not because it's a bad stock, it's because of its domicile. So why is it that nobody wants to invest in China right now? Well, they do have a nasty habit of losing things. For example, billionaires. 2 billionaires have gone missing and then magically reappeared. Here I'm thinking about Bao Fan, but also Jack Ma. And to misquote Oscar Wilde, to lose 1 billionaire may be regarded as a misfortune, to lose 2 looks like carelessness. And it's not just billionaires that they also lose official statistics when they don't look very favourable. For example, the youth unemployment numbers simply disappeared when they topped 20%. So I think the trouble with investing in China is one of transparency and being able to trust official numbers, but also to trust numbers published in annual reports by companies. How can you invest if you don't know what's going on? And at a recent conference in Hong Kong, I believe this was, various fund managers were asked about investing in China, and many of them said that China was simply uninvestable. It's such a small percentage of their overall index, but requires a lot of work. However, for Michael Burry, clearly, it's not an uninvestable market. This is simply an opportunity as he sees it. His calculation is that China is going to ultimately not do something very irresponsible, which will lock it out of capital markets, as happened to Russia. Now, if he's right, he's buying these good companies at very low valuations. So to summarize my take on what I've learnt from Michael Burry, I think it's that things look pretty good right now, both in the US, and perhaps we should be brave enough to also think that things will be okay in China. Although personally, I wouldn't take that risk. My global equity exposure is actually just developed markets. I've excluded emerging markets altogether. What we've seen so far is that China seems to be quite happy to shoot itself in the foot in terms of its own capital markets. And I just think that's unlikely to change anytime soon. Now, today's video is sponsored by Stockopedia, which is something I've been using in my fund portfolio to build and manage a portfolio of single stocks. And these are ones which I've screened based on various criteria. I want small companies which are high value, they're cheap, but also they're high quality, and they also have improving momentum. Why did I build my own stock portfolio? Well, it was because there isn't an index to track that for UK stocks. So I just made my own. Now, that would have been impossible if I'd have had to research all the single stocks in the portfolio. The reason why I was able to do it is because each of the stocks which I include have already been ranked according to criteria created by the analysts at Stockopedia. Now, this isn't just a UK product. You can get various databases for each region. I've chosen UK focus here, but there are multiple regions. For example, Europe, the US, there's also one for Asia. But this is how my ranking system works. I want quality exceeding 50 and momentum exceeding 50. My market cap has to be between 100 million and a billion. And then I sort the results by stock rank. So these are the measures which the analysts at Stockopedia create. Value rank, quality rank, momentum rank, and stock rank. And if you manage to find a stock which combines all three, value, quality, and momentum, that's called a super stock. So let's drill into the one at the top here, which is Reynolds. And you can see that that's classified as a super stock because it combines all of those metrics. So let's look at Michael Burry's portfolio based on these stock ranks. So one of his new choices for Q4 of 2023 is HCA Healthcare, which has an incredibly high stock rank of 95. The other stock ranks also tend to be pretty good, 88, 85, 81 and 64 for Oracle. Notice how both of his Chinese choices, JD.com and Baba, are both classified as Contrarian. What's great about Stockopedia is you can drill into any of those classifications or any of the numbers that you can see on their screening pages, and it'll give you a really good, clear explanation. So if you want to see what Contrarian means, it's a stock which has good quality and good value, but the momentum is missing. So it's a stock which is fundamentally good, however, it's out of favour. As a viewer of PensionCraft, you get 25% off your annual plan if you use the promo code PC25, or you can use the link in the description below. And this is for new Stockopedia accounts. Now let's turn to the Sage of Omaha, Warren Buffett. If we break down his holdings by stock, you can immediately see the huge difference to Michael Burry's portfolio. Berkshire Hathaway's portfolio is very much dominated by one stock, and that's Apple. Now, part of that is due to building up a large stake over time, but it's also because the stock has been so successful relative to Warren Buffett's other holdings. Historically, he's also done very well with his stakes in companies like Coca-Cola, but also financials, such as Bank of America and American Express, and Moody's also provides financial data, so that is a kind of financial company too. Another theme in his investing is energy companies, and as we'll see later, one of the subsidiary companies of Berkshire is an energy company. So now let's look at his portfolio, and we'll just look at the changes since the previous quarter. But before we do that, let me just quickly show you what it looks like if we don't remove the ones where there was no change. So that's one big difference between Warren Buffett's style of investing and Michael Burry's, which is that he very seldom makes changes. When he does do so, it's often quite sizable. But here you can see that most of the quarterly changes are zero. He didn't change his holdings at all. He just cut a few positions and increased a few others. So removing the things which he didn't change, we'll just focus on the things which he did. A lot of people have been talking about his cut in his stake in Apple, but in fact it was only a 1% cut. Now, of course, in monetary terms, that's huge. Given that it's a $174 billion position, 1% of that is going to be about $1.7 billion. Presumably he did that to free up capital for another purchase. It's not because he doesn't like Apple, it's because he wanted to buy something, would be my guess. And what's really fascinating is that there was a mystery purchase which he asked the SEC, the Securities and Exchange Commission, not to have to report. And in special cases, such as his, they do allow that. And 2 successive quarters now, he's had this hidden purchase. Now, we know he did buy something, and it was worth about $1.7 billion. We think it was also in the financial sector. So perhaps that's what he's been buying, and he simply doesn't want to move markets as he builds up his stake and push up the price and have to pay more for his holding. So maybe in the next quarter, we're going to find out what this is. You can bet it's going to be headlines. He also cut 4 of his holdings completely and reduced some others. And his increases were in the energy sector, so in Chevron and Occidental Petroleum. And then finally, he increased his holding very significantly in Sirius XM. So what do we take from this? Well, I think the first point is that the sectors he's chosen weren't chosen at random. If we look at the forward price to earnings multiple average for the US sectors, it's certainly not true that all sectors are expensive right now. The 2 cheapest based on forward price to earnings are energy and financials. And it's exactly these sectors in which Warren Buffett has added to his holdings. So clearly the fact that there's been a bit of a financial sell-off in the United States due to the regional banking crisis has created opportunities. And as the price of energy has fallen significantly recently, that's also pushed down the value of energy stocks, and he's using that as an opportunity to build his stake. And Berkshire's stake in Occidental is already very significant. So if you look at the major shareholders in Stockopedia, here you can see that Berkshire Hathaway already owns 27% of the company. It's by far the biggest shareholder. And his energy holding is an interesting one, because if you look at Berkshire Hathaway's holdings and you look at his companies which he owns completely, because that's what he sometimes does, he doesn't just buy shares, he buys the whole company. One of those subsidiaries is Berkshire Hathaway Energy. And his strategy seems to be to hold fossil fuel companies, but also renewable energy companies. And that's because during this energy transition phase, we'll still need fossil fuel for a long period of time. And during that last puff of the cigarette, as it were, there's going to be profits to be made within that sector. However, once we do get the pivot to renewable energy, he's ready, and he's got that as part of his portfolio already. And finally, his SiriusXM holding seems to be a little bit at odds with the rest of his portfolio. Why is he piling into this stock right now? Well, what seems to be going on is that there are rumours of a takeover of SiriusXM by Liberty XM Sirius Group. So what lots of people are doing is going long the acquirer and shorting SiriusXM, which presumably is pushing down its share price. So if lots of short sellers are pushing down the price of SiriusXM, perhaps that's creating an opportunity. Also, if you lend out that stock to people who are shorting it, you're earning a very good carry, as it's called, at the moment. So stock lending could boost the value of his holding by generating some income for the company. Then later on, if SiriusXM does get taken over, presumably its share price could increase. So if I had to summarise Warren Buffett's position, well, not a lot has changed. He's building up his energy stake. He trimmed his stake in Apple very slightly, but I think that's to free up cash so that he could buy some kind of financial stock. And where he's building his portfolio right now are the two corners of the market in the US, which are currently cheap, which is energy and financials. So I think there are some similarities between what Michael Burry's doing and what Warren Buffett's doing. They're moving into sectors which they think are cheap, or countries which they think are cheap. In the case of Michael Burry, it's China, because it's a really beaten up country, maybe for good reason. And in the case of the energy and financial sector in the United States, again, beaten up and unloved. But maybe this provides opportunities if you've got that long-term mindset and that contrarian mindset and the bravery to run against the herd. Now don't forget our offer from Stockopedia, who's sponsoring this video. You get a 25% discount on your annual subscription if you use the promo code PC25 or use the link in the description below. And, as always, thank you for listening.